The numbers look perfect right up until they don't. On trading floors in Houston, screens glow with profits that seem to appear on command. Deals are signed, earnings are booked, confidence spreads fast. Wall Street calls it brilliance. Employees believe the story. They are told the company is changing the world. Energy is no longer pipes and wires. It is speed, math, and imagination. Their retirement money is pushed into company stock. Loyalty is rewarded. Doubt is punished. Behind closed doors, losses are quietly pushed aside. Partnerships are built to hide debt. Profits are counted before they exist. Executives sell their own shares while urging everyone else to hold. Complexity becomes a shield. Anyone asking too many questions is treated as the problem. For years, the illusion works. Analysts cheer, credit flows, the stock climbs, the company is praised as the smartest operation in America. Then confidence cracks. The stock slips, hidden guarantees activate, cash demands flood in. What was buried off the books starts clawing its way back. By the time the truth surfaces, it is already too late. The money is gone, the trust is gone, and thousands of people are about to learn what happens when belief replaces reality. Chapter 1. The illusion is built. Enron did not begin as a symbol of excess or deception. It began as a regional energy company with pipes, contracts, and predictable margins. By the mid-1990s, that identity was no longer good enough. Executives wanted growth that looked explosive. They wanted numbers that impressed Wall Street. They wanted to be seen as visionaries, not utilities managers. The shift starts quietly. Leadership pushes a new idea inside the company. Energy is no longer just something delivered. It can be traded. Contracts can be bought and sold like financial instruments. Risk itself becomes a product. The pitch is simple. If markets can be created, the company can sit in the middle and skim profit from every deal. Accounting rules open the door. Mark-to-market accounting allows the company to estimate the total profit of a long-term contract on the day it is signed. Those estimates rely on models. Models rely on assumptions. Once approved, the projected gain is booked immediately as revenue. A deal that might last 20 years shows profit on day one. The cash does not matter. The estimate does. Inside the company, this changes everything. Traders are rewarded for volume and complexity, not long-term performance. Deals are designed to look profitable on paper, even if the real-world outcome is uncertain or negative. Future risk is someone else's problem. As contracts pile up, so do losses. Some projects underperform, some never work at all. In a normal company, those losses would appear on the balance sheet. Here, they are treated as obstacles to be managed. Special purpose entities are created. These partnerships are presented as independent businesses. In reality, they exist to absorb debt and losses that the company does not want investors to see. Assets are transferred, losses are parked, the balance sheet stays clean. The structures are complicated by design. They are wrapped in legal language and financial engineering that few people fully understand. That complexity becomes protection. When questions arise, executives point to the paperwork. Everything is compliant, they say. Everything follows the rules. Auditors sign off, lawyers approve, analysts repeat management's explanations. The company's internal culture hardens around performance at all costs. Employees are ranked against each other. Those at the bottom are fired each year. Fear becomes a motivator. Silence becomes a survival skill. Ethics training exists on paper. In practice, it carries little weight. Results matter. If a deal increases reported earnings, it is celebrated. If it creates long-term risk, that risk is invisible. Executives present themselves as disciplined and forward-thinking. They speak in polished language about innovation and efficiency. On earnings calls, they project confidence. Questions about transparency are brushed aside as misunderstandings. Wall Street loves the story. Analysts compete for access. Favorable coverage brings investment banking business. Skeptics are marginalized. Buy ratings dominate. Business magazines celebrate the company as a model of modern capitalism. Awards pile up. The brand becomes synonymous with intelligence and ambition. Inside the workforce, belief spreads. Employees are told they are part of something historic. Stock ownership is encouraged, then effectively required. Retirement plans are loaded with company shares. Selling is discouraged. Loyalty is framed as faith in the mission. At the same time, senior leaders quietly reduce their own exposure. Stock options are exercised, shares are sold, millions of dollars are converted into cash. These transactions are legal and disclosed, but rarely emphasized. The message to employees remains unchanged: hold, believe, stay the course. As the stock price climbs, the system reinforces itself. Rising share value props up the special purpose entities. Guarantees tied to the stock remain dormant. The higher the price goes, the safer everything appears. This creates a trap. The entire structure now depends on confidence never breaking. A decline in the stock price would trigger obligations hidden deep inside the partnerships. Cash would be required. Losses would surface. Internally, some employees notice the strain. They see deals that make little economic sense. They see profits that exist only on spreadsheets. Questions are asked quietly, then dropped. Raising concerns is risky. Careers are built on appearing aligned. Those who challenge the narrative find themselves isolated. Promotions go elsewhere. Regulators remain distant. Energy trading is still new. Oversight lags behind innovation. Complexity outpaces scrutiny. By the late 1990s, the company is no longer managing risk. It is manufacturing appearance. Earnings are smoothed. Volatility is hidden. Reality is postponed. Each quarter that passes without consequence strengthens the illusion. Success becomes proof. Doubt becomes irrational. But the system has no margin for error. Every assumption leans in the same direction. Growth must continue. Stock prices must rise or at least hold. Credit must stay cheap. The illusion is not built to withstand stress. It is built to avoid it. As the decade closes, pressure increases. The deals grow larger. The entities multiply. The explanations grow thinner. Maintaining the image requires constant motion. What looks like genius from the outside is, on the inside, a race against exposure. And the race is about to enter a phase where control slips away. The illusion stands tall, it shines, it convinces, and it is already beginning to crack. Chapter 2. The system starts to fail. The pressure does not arrive all at once. It creeps in through markets that refuse to behave and numbers that require constant adjustment. The company has built a machine that depends on motion. Deals must keep flowing. Prices must stay favorable. Confidence must never pause. Trading desks are no longer satisfied with responding to supply and demand. They learn how to influence it. Energy becomes a game of leverage. If power is scarce, prices rise. If prices rise, profits appear. Scarcity can be managed. In California, the power market strains under deregulation. The rules are loose. The system is vulnerable. Traders identify the gaps quickly. Electricity is rerouted out of state, then sold back at higher prices. Maintenance schedules are used strategically. Bottlenecks are exploited. Internally, the trades are praised. Revenue spikes. The numbers look strong. The human cost, including blackouts and public outrage, is treated as background noise. What matters is that the trades work. Recorded conversations capture the tone. Traders joke about chaos on the grid. They celebrate the cleverness of the schemes. The market is no longer a place of exchange. It is a tool to be bent. At the same time, stress builds inside the accounting structures. The off-balance sheet partnerships were designed to absorb losses quietly. They were never designed to operate indefinitely. Each one relies on a fragile balance of assumptions. Most of those assumptions tie back to the stock price. As long as shares remain high, guarantees stay inactive. As long as guarantees stay inactive, losses remain hidden. But the stock begins to wobble. It does not crash at first, it dips. Analysts frame it as noise. Executives call it a buying opportunity. Employees are told to stay calm. Inside the company, alarms are sounding. A senior executive sends a memo to leadership outlining the risks in plain language. She warns that many of the partnerships have no real independence. She explains that the structures could collapse if the stock price falls further. She uses the words implosion and scandal. The memo circulates, it is discussed, it is acknowledged, nothing changes. Leadership views the warning as a threat to momentum. Addressing it would require unwinding deals, admitting past errors, and taking losses that would shatter confidence. Confidence is treated as the primary asset. Instead, more deals are created. Existing partnerships are reshaped. Risk is pushed further out, deeper into layers of complexity. The explanations become more technical. Fewer people can follow them. Credit rating agencies begin asking sharper questions. They want transparency. They want to understand how much debt sits outside the balance sheet. Meetings are held, spreadsheets are shared, answers are partial. Each inquiry raises the same fear. If the full picture is revealed, ratings will fall. If ratings fall, trading partners will demand collateral. If collateral is demanded, cash will drain fast. The system is now self-policing through fear. Inside employee retirement plans, tension grows. The stock price slips again. Workers try to rebalance their accounts. Many are blocked by plan rules or temporary blackout periods tied to administrative changes. They watch the price move without being able to act. Executives continue to speak confidently. Town halls are held. Emails reassure staff that the fundamentals are strong. The message is consistent. This is a temporary storm. Privately, leadership accelerates personal exit strategies. Stock options are exercised at a rapid pace. Shares are sold into the open market. The sales are legal. They are disclosed. They are not highlighted to employees. As summer turns to fall in 2001, confidence thins. Analysts who once praised the company begin softening their language. Questions grow more pointed. Access tightens. The partnerships start demanding cash. Guarantees that were once theoretical become real. Each demand exposes how interlinked the structures truly are. To meet the obligations, assets are sold. Deals are unwound. Each move creates more pressure. The illusion requires constant repair. Then the repairs fail. The company announces that it will restate earnings. Losses that were once hidden now appear publicly. Billions of dollars in value vanish almost instantly. The stock price collapses. Credit agencies act quickly. Ratings are slashed to junk status. Trading partners pull back. Credit lines freeze. The company's ability to operate day to day is threatened. Inside the headquarters, the mood shifts from denial to panic. Traders watch screens bleed red. Phones ring without answers. Meetings multiply. No solution holds. Employees receive mixed messages. Some are told to prepare for layoffs. Others are told everything will stabilize. Retirement accounts continue to fall. Banks demand collateral that cannot be provided. Deals that once generated profits now generate margin calls. Cash leaves faster than it comes in. Leadership searches for rescue options. Mergers are discussed. White knights are approached. Each conversation collapses under the weight of undisclosed liabilities. The very complexity that once protected the company now works against it. No outsider can quickly understand the full scope of exposure. Trust evaporates. What remains is a countdown. Every hour without new financing tightens the grip. Every revelation deepens the loss of confidence. The system does exactly what it was designed to do. It amplifies movement. But when the direction reverses, it accelerates collapse. By the end of the chapter, survival is no longer the goal. Containment is. The illusion has failed. The only question left is how much damage will surface when it finally gives way. The answer is coming. Chapter 3. Collapsing cost. The end comes fast once confidence breaks. There is no gradual landing. There is no controlled unwind. The system was built to move forward, not to stop. When the flow of credit freezes, everything locks at once. In late November 2001, trading partners begin pulling back. They demand collateral. They shorten terms. Some refuse to trade at all. The company's reputation, once its strongest asset, turns into a liability overnight. Inside headquarters, emergency meetings stack back to back. Executives search for liquidity. Assets are shopped quietly, then openly. Nothing moves fast enough. Every potential buyer demands clarity that no one can provide. The balance sheet is no longer a mystery. It is a warning sign. An attempted merger collapses after a brief review. The hidden liabilities are too large. The risk is too unclear. The deal dies almost immediately. Without fresh capital, there is no path forward. On December 2, 2001, the company files for bankruptcy. At the time, it is the largest corporate bankruptcy in American history. Tens of thousands of employees are affected within days. Jobs vanish, health coverage ends, futures disappear. For many workers, the damage is already done. Retirement accounts are devastated. Years of savings, concentrated in company stock, are reduced to almost nothing. Some employees learn the extent of the loss only after logging in and seeing balances that no longer resemble numbers they recognize. Shock gives way to anger. Anger gives way to disbelief. Investigations begin immediately. Congressional hearings follow. Executives are called to testify. Lawmakers demand explanations. Charts and timelines are laid out in public. The partnerships are dissected. The accounting practices are questioned. The decision-making is exposed under oath. Some leaders claim they acted in good faith. Others insist they relied on experts. Emails and memos tell a different story. Warnings were raised, risks were known, decisions were made anyway. Auditors face scrutiny for approving structures that obscured reality. Banks are examined for helping design transactions that disguise debt while collecting fees. Regulators acknowledge that oversight lagged behind innovation. Criminal cases follow. One senior executive is convicted and sentenced. Others reach settlements or avoid charges altogether. Accountability is uneven. For many observers, it feels incomplete. The company's name becomes shorthand for corporate failure. Business schools turn it into a case study. Training programs dissect it as a lesson in what not to do. Reforms follow. Accounting standards are tightened. Rules around off-balance sheet entities are rewritten. Pension protections are debated. Whistleblower laws are strengthened. These changes arrive too late for those already harmed. Former employees scatter. Some rebuild careers. Others struggle for years. Lawsuits stretch on. Settlements cover only fractions of losses. The emotional toll lingers long after the legal process ends. The collapse also reshapes trust. Investors become more skeptical. Analysts become more cautious, at least for a time. Complexity is no longer automatically celebrated as intelligence. The story refuses to stay buried. Each new corporate scandal echoes familiar patterns: incentives misaligned, oversight weak, confidence mistaken for proof. What makes this collapse endure is not just the scale of the loss, it is the clarity of the warning. The system rewarded appearances over substance. It punished doubt. It celebrated cleverness without accountability. Intelligence was never the problem. Power without restraint was. The illusion worked because too many people benefited from believing it. When belief finally cracked, reality did not negotiate. It arrived all at once. The smartest guys in the room did not fail because they lacked skill. They failed because they built a structure that could not survive honesty. And when it fell, it did not fall on them alone. It fell on everyone who was told to trust it.